Hello and welcome to the Unleash Your Retirement podcast with your host, David Corin. I'm Wendy McConnell, and we have a reoccurring guest today. Is that right, David?
That's right. Mike Smith, partner here at RVA Wealth Management, is joining us again today as we're going to be talking about the election and the markets post-election now. Now that we sort of know, finally, I think just today we got confirmation of who would control the House. So we got the thing that I said we didn't want.
I have remembered this conversation.
Yes, I bet. So I know everybody has out there. If they listen to it the first time, I was saying what we don't want is someone to control all three houses, and that is what we have gotten now. So obviously this was an atypical year election wise. Obviously, I don't know what the right word, historical occurrences. As far as, we had the original nominee step down and Vice President Harris stepped in. We have a former president running for a second time because he was defeated in the last election. So you would think, oh, well, he doesn't have a chance this time around or something like that. But that did not prove to be the case. And clearly we had a we want change election. So this was a bigger change election than I think anyone realized. The polls didn't really show that. But clearly, the incumbent party was seen as the non-change. So even though VP Harris was not the current sitting president, she was part of that administration, and that was the administration that everybody said, hey, we want to change. And when you look across the country, this is as opposed to the first time that Trump won. He actually won the popular vote this time. He got a lot more votes from a lot more demographics when you look across the board. And again, what that tells us is that this was a true change election. And now the federal government is set up to where the Republicans have control of the presidency, the Senate, and the House, which is the trifecta that I did not personally want to see. Why did I not want to see this? As I said before, the reason I didn't want to see this was because we like divided government in the finance industry, because that just basically means not a lot of change, not a lot of policy change, not a lot of tax changes and things like that, because the parties can't push stuff through. Now, all of that is true now. So, and historically, when we look back, whenever one party has controlled all three parts of the government, the stock market has not been stellar. It doesn't necessarily mean that it goes down, but it's not been great. Especially during those years that you have that trifecta in effect. And it doesn't, again, matter whether it's democratically controlled or Republican. It's the fact that we're going to see changes because they will be able to push through their agendas. Now, fortunately, the House is razor thin, so that might help slow things down. If they vote along party lines going forward, then they may be able to implement all of their issues. So now let's talk, Mike, a little bit about this is what we got. So where do we think things are going to go from here relative to the markets? Because we know that there's going to be policy implementation at the very least. Certainly, we're going to see tariffs. We're certainly going to see, hopefully, the tax laws not change a whole lot because they were due to sunset next year. But this is basically the Trump tax cuts are already in effect, and they were going to sunset after the end of next year. So now maybe they won't. What do you think?
Yeah, I don't expect any changes from the individual side. Any increases that they were anticipating if Harris had been elected. One thing we will see, though, corporate tax cuts will be coming. It's a little complicated because a lot of times corporations aren't paying the full tax rate anyways. But this is definitely going to help EPS. The corporations are going to be keeping more of what they make. What's been interesting is we've had a really strong stock market this year. The economy has been humming right along. No recession in sight.
In spite of inflation and an inverted yield curve.
Yeah. And post-election, we saw a big move up in the market on an already nice year. Small cap stocks started to appreciate. Financial stocks are really doing well because what's coming now is deregulation is coming. and that will benefit financial stocks, which are already doing pretty well. Economy's doing well, and we've got the economy growing around 3% right now, which is very healthy for a large economy. The rest of the world's having a tougher time growing, but the United States is really kind of humming on all cylinders right now.
So it sounds like, basically what you're saying is that fiscal policy is going to be stimulative overall.
I don't see, despite some of the big headlines going on with possible cuts by Musk, there's not a lot of cuts coming. We are running at a really high rate. The last time we saw spending at these levels was during wartime.
Mm-hmm.
We really cranked things up during COVID, and some that could be justified. But now we haven't let off the spending for some reason. We're still spending like we're at war.
Right. And I do think we will see less regulation, right? So that's good news for financials, energy, and tech. So that's all good in some ways. The downside is going to be tariffs. Talk to me about tariffs, because that's the one thing I know in 2018 we had a big scare when Trump put some tariffs on China, I believe.
Yes.
So that's a concern of mine.
Tariffs hurt the market late 2018. Trump really went to war in some regards with tariffs with China, and there's already a lot of talk. And he has both sides of the aisle on his case. Really, the anti-China rhetoric is cranked up here. So there'll be winners and losers with that. China has a massive trade surplus that we're trying to chip away at. We're trying to encourage more manufacturing in the United States, obviously. That's inflationary.
Mm-hmm.
But there's a lot to be said. We need to not have such a reliance on the supply chain coming out of China. We felt that during COVID. What it will probably mean in the long term, how much comes through, we'll have to see. Sometimes Trump will use it almost as a weapon, and then he'll start to negotiate.
Oh,
But I do think some things will be coming, and it'll be inflationary most likely. They'll have to pass these costs on to the consumer.
Yeah, one of my concerns is that did we lower rates too soon, and now that Trump's coming in, he's going to do some inflationary things that could hurt us. But talk to me about, we've been for some time now, our theme of our investing, if you will, has been into AI related companies and infrastructure related companies, in terms of a rebuild out across the country. Do you think we need to change that theme at all, or do you think we're going to sort of really stick with that?
We're going to stick with that. We're still early innings here on this AI build out. The amount of power needed, chips, it's really just begun, and it continues regardless of which party's in office. Honestly, right. This is a mega trend right now. There's a lot of spending and catch up going on, and these corporations realize they have to be involved, or they're going to be left behind. And AI is deflationary, so it's going to help these companies become more profitable. There will be, obviously some cost of jobs in some cases that'll be removed by AI, but we're already seeing that. We need to stick with that trend for sure.
Yeah. So when you say AI is deflationary, I think that, what you're saying is the productivity gains are deflationary. I think that's what that's, to me, when I think of what AI's impact will be, I do agree. It'll be deflationary because it will improve profits by improving the productivity of the entire workforce in a big way. And I know that, I think talking to someone the other day, said that Elon Musk at X now, formerly Twitter, one of the things he did was he instituted a massive layoff in there and just replaced everybody with a lot of that stuff with AI. And it's worked in a big way, in a very positive way. So, we could see something like that at the government level, where they do actually cut spending in the government. I mean, I heard you say they wouldn't earlier, but I mean, there's a chance, that they might, because, we saw something the other day. My wife was talking, and she said, I think we need to buckle up. There's going to be a lot of changes coming. So I think she may be right. There are going to be, because really, when you think about it, Trump can't run again. So he's in, and he's going to do what he feels, and he learned a lot, I think, the last time around. So I have a feeling, we are going to see a lot of changes. I don't know what they will look like, how it will play out. There's going to be a lot of discussion and back and forth as they make the sausage in Washington, because really that's what they're doing up there. It's a lot of in and out and a lot of negotiation. So we don't know what the final outcome will be, but one thing is for sure, we're going to see a lot of change. And you couple that with the change we're going to see just from the implementation of AI throughout the economy, we should buckle up. I mean, I think that's what we're looking at right now. So as far as a forecast is concerned, let's say remain bullish. Let's stick with that theme that we've got with the industrials and the AI type of play. I agree. I think that is exactly how things are going to play out. We should stay bullish on those things in those categories. I do think that we're overdue for a correction, right?
Yeah, we see a 10% pullback most years, and we have not experienced one in quite some time now, which is unusual. And we're going on 2 really strong years in a row now. So I'm optimistic about next year and the end of this year. We may not see these big returns we've gotten the last 2 years, though. We may have to temper those expectations. Yeah. But I would caution people that want to be too much into bonds right now, because after the election of Trump, the bond market has sold off, with the thought being we won't be able to cut as much as they initially thought on rates. And maybe bonds just kind of stay where they are for a while. We're getting some pretty decent interest, but I wouldn't expect big overall returns from the bond market.
Yeah, so we're not going to see a big decline in interest rates, which would drive up the bond market quite a bit. So we'll probably stay in this range, is what you're saying, which I hear you saying. So, and I do agree with that too. So, yeah, I mean, when I look forward, again, this is all based on what I've seen historically and just my thoughts in terms of where we're going next year. I think we're going to get a pullback, like I said, because we're overdue for nothing else, and we've had such a big run up for the past 2 years. Historically, first quarter often has a pullback in it. I don't know exactly why, but a lot of times first quarter or second, sometimes it's delayed to the second quarter. But my belief is it'll be first quarter, because I think Trump will be in office and we'll see the tariffs right out of the gate. I really do. And I think when we get those tariffs and we actually see what they are, it depends on how difficult they are, how bad they are. I think the market pulls back at that point, and we'll get that 10% correction. But I don't see us moving into recession like a lot of people are warning. I've heard that, Warren Buffett's sitting on $350 billion in cash, and that's because he's waiting for the market to crash. And I don't think that's the case. Basically, when he's been queried about why he's got so much cash, he has said, I just want to do a big deal. I'm looking for a big deal. And he'll wait until he has the opportunity to do that. So that right now he can't do that because the market is definitely up quite a bit. And he's not going to get a great deal if he goes out there to try and buy into a firm or buy a company. So he's waiting for things to cool down, and then he'll put that cash back to work. That's what I'm thinking. But that's what he's typically done historically too. So I don't see a necessarily recession next year. I do think we'll get a market pullback, but I don't think it'll be, certainly we won't see the kind of returns we saw this year, with I think the S&P is up 27% or so at this point. I don't think we're going to see that next year. And we saw a big, what was it last year? It was up in that range as well last year too. So we've had 2 big years, but keep in mind, 22 was awful. I mean, it was a bear market. What was it? 30% for the NASDAQ, over 20% down for the S&P. So it was a rough year. And that was only a couple of years ago. So bull markets can run for a long time, right?
Absolutely.
We just need a correction. I mean, that to me is important, is that we do see a correction to take some of the steam off from the market, release that steam, if you will. And it gives us an opportunity to have Warren Buffett put his money back to work. So yeah, I think you're right, Mike. I think stay the course, stay bullish, especially in themes that we're following, because I don't think they go away. It's a longer term trend, that AI and industrial sort of infrastructure build out that we know needs to be done. Stay with those types of companies, and then weather the storm as we move forward. Don't go heavy into bonds at all, because I don't think we're going to see a much larger drop in interest rates. If anything, they could go back up again because of inflation, right?
Yeah, I would argue even the Fed cut 50 points in September. They just did a small 25-point cut. And I would argue to say they could almost stay put where they are. They'll probably do a few more cuts, but the way this economy is humming along and the way that Trump wants to stimulate even further, the Feds probably should think about backing off here.
Yeah, and I would not be a bit surprised if that is what happens, just because I don't see the need to lower the rates that much, because, like you said, the economy is doing great, right? I mean, it's really cooking out there. I don't know. What do you think of all this, Wendy? You're more of you're not in the weeds of this like we
I'm a
are,
layman.
but yeah, you're a layman. So what do you think of all this?
I don't know. I was worried because I remember you saying that once, one party controlled everything, that was going to be bad news. But now you're saying that you don't think it's going to be necessarily bad news. It's just it won't keep growing the way that it has been.
Right. And when I say bad news, I'm just saying historically, when one party controls all three houses, the stock market returns have not been stellar at all, but they've still gone up. I haven't seen necessarily declines in a big way, but it's been very, very spotty usually for the 2 years because right now you're looking at 2 years of Republican control of all three houses. I mean, all three branches of government. And that's a long period of time. But and normally it flips, by the way, almost always. Whenever this has happened historically, you usually get a flip, usually in the House, and the House is razor thin. So I could see that changing after 2 years. But during these 2 years, the markets don't give stellar returns usually because lots of changes occur. And it takes the business community a while to digest new policies, new programs, new tax codes, new regulations, if there are any, et cetera, or deregulations, and how is it going to impact them. So that's what we're looking at.
So we're not going to see the market take a dive or anything like that.
Yes, we are. You misheard me. What did I talk about? I said a 10% drop. Yeah, it's coming.
Oh,
Well, probably first quarter.
well, you use that correction term. I'm like, can we not?
Yeah, correction, but
Stop
that's
saying
a drop. That's a drop.
I'll say I don't like the term dive. I think
Yeah.
correction sounds a lot nicer.
Yeah, we're trying to be nice, with our.
All right. So,
It's always painful when the market goes down 10% or more, but it's
but that
normal.
hasn't happened yet.
No, it hasn't happened since 22. So, but we're thinking we're overdue because it usually happens once a year, and we haven't seen it now for over 2 years. So we're expecting it. It is normal. And that's what we stress with our clients. It's normal for the market to drop 10% in any given year. Doesn't mean that the whole year is going to be a loser at all, because normally the market works its way back up again even before the end of the year. But we will get a 10% correction or greater. It could be bigger than that, especially if we get some pretty severe tariffs and stuff early next year. We could see a bigger correction. But I don't think it'll be like the end of the world kind of thing. I don't think we're heading into another 2008 or 2000. I don't see anything like that, but I do see a correction and a pullback.
When it comes to the tariffs, we really need to be bracing ourselves for some higher prices. Do you have any, tips on what we should be doing now to prepare for that?
Yeah, that's a really good question. That's one of the problems with tariffs, because you just don't know what they're going to hit and how it'll play out until you know what the tariffs are. Prices could go up and again, this would be on imported goods, primarily, I think, from China, but could impact other countries as well, but certainly China will be targeted. And so the goods that you're getting from China will probably cost more. Now, what are those goods and which goods? It's not going to be everything, and it's hard to say what will be targeted, because that's sort of how tariffs work. And we'll have to wait and see what actually comes down the pipe from the administration in terms of those tariffs. And then we could say, this is what you might want to do to prepare for that. Because otherwise we just don't know. It's going to be a real question mark. And, you don't want to go out there and hoard stuff now and pay lower, thinking, I'm going to pay lower prices and buy a bunch of stuff that you may be buying the wrong stuff. It's the same price.
Right.
Was it during COVID that you couldn't buy? Yeah, we couldn't buy. I remember this. Went to the store to get toilet paper. There was none.
It was gone.
It was gone. I was like, what in the world? It was nothing there.
That's made here, though, so we don't have to worry.
Yeah, that was made here. So I don't know what to do. So again, I don't know, what will be hit. I don't know that we'll see like that where you won't be able to find anything in the grocery store. And I certainly don't want to be the person that starts the trend of buying stuff up that you think is going to go up in price. But certainly there will be some of that once the tariffs come out. Of course, the pricing changes will probably be pretty swift once we know what the tariffs are.
Okay. Well, I'll visit back with you in a couple months.
Yeah, we will revisit this in the first quarter. That's for sure. This is something we'll take up again when we talk about the markets. I think I've done 2 podcasts now really on this election. I did a pre-election podcast, and I did a post. The pre-election podcast was sort of say, hey, don't worry, shouldn't be the big deal. We'll still have divided government. Not a lot is going to happen, no matter which party wins, blah, blah, blah. That's what I said. Well, didn't work out that way. We got a one-party control. And so that's why I felt the need to really do another podcast on the topic right away.
You scared everyone.
Yeah, I was thinking about that. I probably did scare everyone. And we don't want to scare you, but know that, now we really are in a situation where government is going to have an impact because there will be changes. We don't know what those changes are. We need to be flexible and be ready to react. But we feel pretty confident about the themes that we have chosen in terms of investing for our clients and in the risk profiles that we have them in, so that they can withstand whatever comes down the pipe. That's really the thing that's sort of critical, is to know that, with a good plan in place, knowing what your risks are, knowing what your spending is going to be, what your needs from your portfolio are going to be, you can invest comfortably and confidently, regardless of where the markets go. Whether they go up or down, you're fine. You don't have to worry about it, and you shouldn't. You really should be in a position where you don't worry about what goes on in the market, because over the long haul, 5 years plus, markets will go up. You just need to be able to hang in there and not sell when the market's down. And we don't want to play that time the market game at all. You want to be in a risk profile that you're comfortable with, invest that way, and stay invested that way. Would you agree, Mike?
Absolutely. Yeah, this is going to be a really good decade for stocks. So sometimes you just have to turn off the news. Don't worry. It's going to be okay.
Yeah. For those of you scared to death because Trump was elected, don't worry about it. It's going to be bumpy, yes, because he got everything that he was looking for. So we are going to see some changes, but we will survive this. Even this, we will survive.
And the midterms are coming before you know it, and there'll be some tough Senate seats for them to defend, and we could see a divided government in 2 years.
We probably will. Historically, we always have seen divided government after 2 years, because people get filled up with all the stuff that control gives them, and they want change again. So my guess is we'll get change again, although it'll be in the opposite direction next time, more than likely.
All right, guys, you have calmed me down and quelled my fears for the time being, so I thank you for that.
Yes, hopefully that's the case for everyone out there.
All right, guys, so how can people get in touch with you if they have a couple more questions for you?
If they have questions, you can reach our website, rvawealthmanagement.com. You can click and do a 20-minute Ask Anything, or you can do an initial consultation with us. They're all free. You can also contact us through the website if you have questions. So, RVA Wealth Management, we look forward to hearing from you.
All right. Thanks again. And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time.
Thank you for listening to the Unleash Your Retirement podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.rvawealthmanagement.com or give us a call at 804-497-2100. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of RVA Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analysis of RVA Wealth Management. It does not necessarily represent those of RFG Advisory, Private Client Services, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by RVA Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Private Client Services, RVA Wealth Management, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.